let's dive into a question that honestly trips up a lot of people, even experienced investors. What is the real, true initial cost of your investment property? It sounds simple, right? But you'd be surprised what's hiding under that initial price tag.
So imagine this. You just signed the papers for a new property. You've got that big number, the purchase price, right there on the contract. Is that it? Is that the number you jot down in your books? It seems like it should be. But here's the thing. It's almost never that simple.
Yeah, the answer is a big, resounding no most of the time. That price tag, think of it as just the foundation of a house. It's the starting point. To get the real cost, we actually have to build the rest of the structure on top of it, piece by piece. So let's do that together. All right, first up in our construction project, the essential add-ons. These are the costs that you absolutely have to include. They're non-negotiable if you want to get an accurate starting value for your asset. So what are we adding to that initial purchase price? Well, there is a checklist. You've got your professional legal fees, right? Those count. Property transfer taxes? Yep, add 'em in. Costs for getting planning permissions? For sure. And even stuff like one-time joining fees for a building association. You see the pattern here? The key is that they are all directly tied to actually getting your hands on the property. And look, this isn't just my opinion. It's a fundamental accounting principle. Any expense that's directly linked to the acquisition becomes part of the property's official cost. That direct link is the phrase you really need to remember. Okay, now for the flip side, which is just as important. What do we leave out of our build? This is all about learning to separate the costs of buying the asset itself from the costs of running your business. They are two totally different things. Here's where the line is drawn. On one side, you have the costs to acquire the property. We capitalize those, which is just a fancy way of saying we add them to the property's value on the balance sheet. But on the other side, you have costs to launch the business. Like throwing an opening party or running a big ad campaign. Those are day-to-day expenses that get deducted from your profit and loss. And just to be super clear, you're also going to exclude any refundable taxes. I mean, it makes sense, right? You're getting that money back, so it's not a real cost. Same goes for those startup costs we just talked about. And here's the big one people often miss: the interest you pay on a loan to buy the property. That's usually seen as a financing expense, not part of the property's cost. Okay, enough with the theory. It's great, but let's make this really stick. We're going to take all these rules and apply them to a real-world example step by step so you can see exactly how this final number gets built. Ready? Let's do the math. We'll start with our base, a purchase price of 30 lakhs. Okay, step 2, add the transfer taxes of 1 lakh. Now we're at 31 lakhs. Step 3, tack on 20,000 for legal fees. That gets us to 31 lakh 20,000. Then, here comes a bigger one, 2 lakhs for planning permission. We're up to 33 lakh 20,000. And finally, let's add 6.6 lakhs for some necessary construction. And that brings us to... And there you have it. The real, true initial cost of our property isn't the 30 lakhs we started with. It's almost 40 lakhs. See how all those little extra costs stack up? This gives you a much, much more accurate and obviously higher valuation from day one. But wait, what if you don't pay for it all up front? What if you pay over time? Well, that adds a whole new tricky layer to our calculation, the element of time itself. So let's ask a new question. What if you agree to pay for your property, but your payments are spread out over, say, 2 years? Does that change the cost of the asset you record in your books? You bet it does. Absolutely. This brings us to a really important concept: the cash price equivalent. It's actually a pretty simple idea when you break it down. Just ask yourself, What would this property cost me if I paid for all of it, right here, right now, in cash? That number, that is its true cost for your accounting records. So here's the bottom line. Any amount you pay on top of that cash price equivalent, that's not part of the property's cost. That's considered interest. It's the cost of financing, the price you pay for the convenience of delaying payment, and it's handled completely differently in your accounts. Let's look at a quick example. Over 2 years, you might pay a grand total of 1.2 crores. But if that property's cash price today is only 1 crore, then guess what? The asset's cost is 1 crore. The extra 20 lakhs you're paying, that's your interest expense, and you'll account for it over that 2-year period. Simple as that. So, we've built our number, we've thought about the time element, but let's bring it all home. Why does getting this one single initial number right actually matter so much in the grand scheme of your investment? Because everything, and I mean everything, that comes after is built on this number. It's the foundation. How you calculate depreciation year after year, how you value the property on your books down the line, and most importantly, how you figure out your actual profit when you eventually sell. It all comes back to getting this initial cost right. If you mess this up at the start, everything that follows will be off. So there you have it. Nailing down that true initial cost is the essential first step. But of course, that immediately leads to the next big question every investor has to face. Now that you know what it was worth on day one, how on earth do you measure its value tomorrow and the day after that? Well, that's a story for another time. Thanks for joining me.